Let's talk about 401ks. 401ks are government-sponsored qualified retirement plans. This is where we have traditionally been taught to hold our wealth for retirement. It's what our parents were taught to do. It's what we were told to do. Grow up, get a good job with good benefits. It's going to give you 401k matching, lots of vacation time, and health insurance. The fact of the matter is, though, nobody gets independently wealthy off of a 401k. They are not designed to work for the employee. They are designed to be in a tax shelter for the employer. And there are a lot of other disadvantages just besides that one fact for the employee. So let's go through them. There's 3 questions that you need to ask about your 401k. 3 fundamental questions, or any investment in general. Number 1, because we're putting money in pre-tax, we need to ask the question, are taxes going up in the future or are taxes going down in the future? I would contend that taxes are going up in the future. Number 1, we're $30 trillion in debt. What $30 trillion of debt means, and that's a big number to wrap your head around, but let's try to bring some context to it. If you or I were alive whenever Jesus was born, and we were to have spent $28,000 a minute since the minute that Jesus was born, we still would not have spent $30 trillion. That's a whole lot of debt. And the federal government is still operating at a deficit. So that debt is going to continue to grow. The only way for them to possibly service that size debt is, number 1, to print money, or number 2, to raise taxes. We're already seeing the Federal Reserve struggle to battle inflation because they've printed so much money already to cover that debt. So are taxes going down in the future? Are they going up in the future? I think they're going up in the future. Also, if we look at an income tax reform from 1913, whenever the income tax was instituted, we can see that if you made between $20,000 and $50,000, you paid 1% on that bracket. And $20,000 was a lot of money back in 1913. That would be the equivalent of a 6-figure income. If you made $50,000 to $75,000, you would pay 2% on that bracket. $75,000 to $100,000, 3%, $100,000 to $250,000, 4%, $250,000 to $500,000, 5%, and anything in excess of $500,000 was taxed at 6%. So historically, what have tax rates done? They've gone up. The highest tax bracket in 1913 was 6%. The highest earners in America right now are paying over 50% taxes between federal and state taxes. So are taxes going up or down? They're probably going up in the future. So why would we want to save money now for it to be taxed in the future? Some people would contend that, well, my income will go down in the future, so I'll be in a lower tax bracket. Number 1, there's no guarantee of that. Even if your income is to lower, you still might be in a higher tax bracket when you retire because of the federal debt. I don't know why you would want your income to reduce in retirement. Why would you all of a sudden want to start making less money? I want passive income by that phase of my life. I want to reach some goals to where my income is ever increasing. And I really don't want to retire if I don't have to. I love what I do. I want to keep working. So because taxes are going up in the future, because we'll probably be in a higher tax bracket whenever we withdraw money from our 401ks, then that first rule, that first question that we ask, that test that we apply to the 401k fails. Question number 2, would you rather pay taxes on the seed or the harvest? Would you rather pay on a little bit of money or a lot of money? I think that answer is fairly obvious. You would want to pay taxes on a smaller amount of money than a larger amount of money. So if the underlying investments of a 401k do work, which typically they don't, why would you rather pay taxes on a larger amount of money down the road? And question number 3, is a dollar worth more today or worth more in the future? We have to ask this question because we are separating ourselves from our money in the 401k. Would I rather go ahead and pay taxes on the seed and have access to that money today, or pay taxes or have access to that money 40 years from now in the future whenever I withdraw it. Is a dollar worth more today or in the future? Well, obviously it's worth more today. Number one, because of the time value of money. And number two, because of the inflation, because the decrease in the purchasing power of the dollar. Bacon's up 30%. Gasoline is up over 100% in some markets. Inflation is crazy right now, and it's not going to get any better. So would your dollar can your dollar buy more today or in the future? It can buy more today. Think about a candy bar when you were little. A king-size candy bar would be 99 cents. Now it's maybe $1.99. Maybe it's $2.49 for a king-size candy bar. So qualified plans violate these three basic financial principles. They fail these three questions that we're asking. Qualified plans make you save money pre-tax, but taxes are going to be up in the future. We're going to be in a higher tax environment in the future. So why wait to pay taxes at a higher rate? Number two, you're going to pay those higher taxes on a larger amount of money. And number three, you are going to receive dollars of lesser value at the time of withdrawal. Those dollars are going to have much less purchasing power in the future than they have right now. There is the Roth IRA, which allows you to save post-tax dollars if your income allows. But the Roth IRA passes the first two questions, the first two tests. Are you going to be in a higher tax bracket? Yes. Well, the Roth IRA makes you pay taxes on money now. And would you rather pay on the seed or the harvest? You'd rather pay on the seed. The Roth IRA fulfills that question also. But the Roth IRA does violate the third principle. You are still separated from your money. You cannot access it and use it. You receive dollars of lesser value in the future. So all the dollars that come out of the Roth IRA may be tax-free, but they're still worth less than the dollars you contributed. And a Roth conversion, if you do need access to that money, a Roth conversion is a taxable event. And the regulations and costs are becoming more and more onerous for self-directed retirement accounts. So who are these types of accounts designed for? With these three questions asked in mind, do you think that these qualified plans are designed for you or your family or for the government? These plans are designed. Are you not the least bit suspicious of these 401k tax qualified government sponsored plans? If I were to break your legs and then hand you a pair of crutches, would you thank me for the crutches or would you be mad about me breaking your legs? The same concept applies here to the 401ks. The government's creating the problem, creating a solution, and we should be suspicious of that solution. There's no other phase in life besides retirement where people so blindly trust the government. People generally don't trust public schools to do a good job educating their kids. They don't trust Medicare to properly take care of their loved ones in retirement. They don't trust the government to tell them the truth through the media. They don't trust the government to do much of anything in their lives, except for when it comes to 401ks. It seems like people can't get enough money in these government-sponsored retirement plans. So I contest that if we don't trust the government to manage our health care, to raise our children, then we also need to be skeptical when the government is telling us where to save for retirement. One of the most egregious things that a 401k does to us is it separates us from our capital, creating a dependence on third-party finance. And here's how it breaks down. These qualified plans put you in a penalty phase for 80 to 85% of your life. So if you were to start working at 19 and a half, from 19 and a half to 59 and a half, your 401k contributions would only be accessible via penalty and ordinary income tax. So there's a 10% penalty if you withdraw out of your 401k, and then on the withdrawal, you also pay an ordinary income tax. So that'd be about a 35 to 45% total. And then from 59 and a half to 72, you get these 13 magical years where you can actually withdraw money and only pay income taxes. Now, again, you might be in a higher bracket and you're paying on the harvest, not the seeds, so that's disadvantageous. But at least you're not under subjective penalty. And then from 72 on, if you don't take any money out of your account, or if there's still money remaining in your 401k at age 72, the government makes you withdraw that money. It's called a required minimum distribution. And if you don't withdraw the required minimum, they will tax you on 50%. They will apply a penalty of 50% to the money that you should have taken out but didn't. For the first 40 years and then the last 30 years of your life, you are under penalty in one of these 401ks. Here's another crazy statistic. 45% of people during their lifetime liquidate their 401ks because of a medical emergency, because they want to go start a business. During the 2007-2008 housing crisis, about 68% of people liquidated their 401ks. 68% of 401ks were liquidated during that housing crisis because everyone was was cash poor. So they needed to access their cash. So the separation of capital, the penalty phase, is really what hurts people and creates a dependence on third-party finance. The average American family is losing 35 cents of every dollar to interest payments to third parties because they feel poor because they don't have access to the money in their 401k to go finance the major purchases of their lives. So these 401ks, in summary, violate the laws of use. You give up or restrict control, use, and liquidity of your money. 80% of the time of ownership, you're in a penalty phase. You pay all the fees, and you assume all the risk. So again, I ask the question, who is this designed for? You, your family, Uncle Sam, definitely Uncle Sam. So enter into the picture this man named Nelson Nash, R. Nelson Nash. He wrote a book called Becoming Your Own Banker. It's available on Amazon. It's also available now on Audible. Highly recommend the book, Becoming Your Own Banker. It solves this problem of separation from your capital and the three questions that we asked earlier. Before we dive into the infinite banking concept and becoming your own banker, let's talk a little bit about banking in general and the need for finance in your life. Everyone has a need for finance, and you finance everything that you buy. You either finance it by paying interest to someone else when you formerly finance, when you borrow money, or you give up the interest you could have otherwise earned by paying cash. So let's look at three financing methods. The first financing method is borrowing someone else's money and paying interest on that as you pay it back, right? So this is traditional financing. You borrow $25,000 to go buy a car, and then you pay off that car note over 5 or 6 years. As soon as the car gets paid off, you probably need a new car. So you borrow another $25,000 and then you pay off that car note. The moral of the story is you always end up back at zero. Cash financing, the Dave Ramsey method. You save up your money, you save up cash, and then you pay off that car in full up front. You don't formally finance it. You don't go in debt to buy a car. This is better than traditional financing because you're not paying interest on the $25,000 that you borrow to buy the car. If you are cash financing like Dave Ramsey, you also wind up at zero because you save and save for 5 or 6 years, and then you buy the car, and then you save, and then you buy the car. You always end up, whether you go into debt and pay off the note, or whether you save up and buy the car all at once, these two people, cash financing and formal financing, always end up at zero. When you cash finance, yes, you are not paying the interest owed to someone else, but there's an opportunity cost to paying cash. And that opportunity cost is the interest that you could have earned otherwise on that cash. So if I saved up $25,000 and I go buy a car, then I have a car and I no longer have the $25,000 cash. But what if I were to save up $25,000 cash and instead of buying a car, invest in some vehicle that got me, say, a 5% return for 25 years? So Then, instead of buying a car, I invest my $25,000 into this investment vehicle that's earning me 5% compounding over 25 years. That $25,000 over 25 years turns into $101,000. So $76,000 in interest over 25 years that I could have earned instead of going to buy that car. So that's the opportunity cost. I either buy the car or I invest the $25,000 and turn that $25,000 into $101,000. So the opportunity cost of owning the car is $76,000 in interest that I was not able to earn. So there is a third type of financing, and banks understand this. It's called leverage financing. And what banks do is they take your deposit, and then the government legally allows them to create leverage. And what I mean by that is the bank can take a $100,000 deposit from you. Let's say you keep $100,000 in your bank account. For each $1 on deposit, the bank can leverage up $10 and go loan that out to people. So if you deposit $100,000 in a bank, the bank can then go loan out $1 million worth of loans. It's called fractional reserve banking. And it is the source of this inflation that we're seeing right now. But banks are able to leverage your deposits by 10x and then go loan that money out into loan portfolios. The bank, if we say generously, pays you 4% on your $100,000 because you have a CD or whatever. The bank typically makes about 44% in their loan portfolio. So how much more is the bank making than you are? You're making 4% on your $100,000. The bank is making 44% on your $100,000. Thinking linearly, and I thought like this when I first heard the question, the bank's making 40% more than me, right? 44 minus 4 equals 40. But if the bank is making 40% and you're making 4%, that means the bank is making 10 times more than you. Banking is the most profitable business in the world because they can practice leverage financing. And the leverage that they practice is immoral and evil because they're creating money. Whenever you go take out a loan from a bank, they create money that didn't previously exist and loan that out to you by fiat, by government decree. So that's not good. But if we understand how we could practice leverage financing and put that into our own financial system, then we would all benefit like the banks. So if the bank's earning 1,000% more than you, then let's ask the question, who would you rather be? The banker or the borrower? You'd rather be the banker, right? Obviously. But we have to be the borrower. Everyone has a need for finance. We have to go purchase food. We have to purchase cars. We have to purchase gasoline. We have to purchase houses. I have to purchase diapers for my 1-year-old. So I also have to be the borrower. I have a need for finance, but I would like to be the banker. But I would also like to be the bank owner because the banker's really not the one making all that money, right? The banker just kind of decides whether you get a loan or not and then what the terms of repayment are. So if we think one level deeper, we would want to be the bank owner, the banker, and the borrower. In an ideal situation, we would have control of all three aspects of the banking function in our life. Okay, so how do we do that? Through leverage financing. Leverage financing employs compounding interest, what Albert Einstein called the eighth wonder of the world. So let me ask this question. Would you rather have a penny that doubles every day for 30 days or $1 million? What would you rather have? The answer that most people give is $1 million. But with the power of compounding interest, one penny doubling every day for 30 days on day 30 will equal $5.3 million. So the question is, if you chose this penny that was doubling every day for 30 days, at what point would you want to withdraw your money, make a purchase, and start the compounding all over again? On day 15, you have $163 in your account. The penny has doubled, so that on day 15, there's $163 sitting there. You could withdraw that $163 and go buy a nice dinner. And if you didn't interrupt that compounding interest, you would have had $5.3 million. On day 25, there's $167,000 there. So on day 25, you could go buy an investment property for $167. But then you could have just waited for 5 days and had $5.3 million. So at what point would you want to withdraw your money and start the process all over again? Never. You would want to wait the full 30 days because that's the power of compounding interest. So here's the question. What if you could use your capital without interrupting the compounding effect for the rest of your life? And what if it compounded at dividends and interest? Okay, that is leverage financing. If I am accumulating capital in an asset, the last thing that I want to do, especially an asset that is ever increasing, the last thing that I want to do is liquidate that asset to go make a purchase, right? You can think about it like this. If I have stocks that are performing well and I need to make a purchase, why would I go sell those stocks, pay capital gains, and make a purchase? Those stocks are rising, so I would want to leave the money in the stock, not liquidate it. But if I have some way to leverage against that stock, if it's in a leveraged brokerage account, then I could borrow against the value of that stock and have access to that capital to go make that purchase that I need to make. So that's risky to do with stocks because stock values can decrease, they can fall. And if you have an outstanding loan against a stock value and it falls, they can make margin calls and then you have to sell your stocks. Happens all the time to people. Happened to my buddy just the other day with his Tesla stock. What the infinite banking concept, as described by Nelson Nash, what becoming your own banker allows you to do is store your money in an asset that is contractually guaranteed to increase over time and never decrease. And it allows you to take a loan against that ever increasing equity that you have in that capital accumulating asset. It allows you to create a pool of capital that you can access via loan without liquidation, never interrupting that compounding interest. So the way that works is described in Nelson Nash's Becoming Your Own Banker. He calls it the infinite banking concept. What you do is you pay a premium into a properly structured dividend-paying whole life insurance policy. And because of the nature of the contract of the dividend-paying whole life insurance policy, that policy is technically an asset. It is one of the safest, most secure assets that you can own. The Dodd-Frank Act of 2008-2009 actually requires banks to keep a certain amount of their assets in Tier 1 capital because of what happened with the housing crash and the mortgage crisis back in 2007, 2008. And so what is the asset that banks keep the majority of their capital in? Dividend-paying whole life insurance. Big banks, Chase, Wells Fargo, Barclays, Bank of America, 25 cents of every dollar of profit that they collect goes towards dividend-paying whole life insurance policy. They're called BOLIs, B-O-L-Is, bank-owned life insurance. Big banks are the largest purchaser of dividend-paying whole life insurance. And the reason is because it is a safe, secure asset that they can keep on their books, an asset that builds equity, that compounds at both dividends and interest. And we have the ability to own this too. And we actually have the ability to use the cash values, use the equity built up in these policies. We can pay a premium into one of these dividend-paying whole life insurance policies, build equity in the policy, and then take a loan against that equity to then go make the major purchases in our life. The average household, I mentioned it earlier, the average American household loses about 35% of every dollar to interest to a third party. Yeah, we finance our cars at 1.9%. But what you have to do is calculate the volume of interest, not the rate of interest. We finance our homes right now at 4%. Some people can get 6 or 7%. If I finance a $400,000 house, I'm going to end up paying about $400,000 in interest. So while my rate might be 4%, my volume is 45 to 50%. That means every dollar that I pay towards my house, 45 cents of that dollar ends up going to someone else's bank. What if, through a dividend-paying life insurance policy, you could recapture that lost interest into your own banking system? Is that something that you would want to do? I contend yes. I do it myself. It solves for a lot of problems. I'm able to accumulate much more money and by cutting banks and third-party financiers out of my life. Now, like we mentioned earlier, some people do this by paying cash. Dave Ramsey recommends that you cut out those third-party financiers by paying for cash. But what he doesn't calculate is the interest that you could have earned on that money over the rest of your life. Dividend-paying whole life allows us to earn interest on our money and through leverage, through a loan, access that money to make purchases without interrupting the interest accumulation. That is the power of dividend-paying whole life. I'll give a quick example. Haley, my wife, wanted a camera. She wanted an $850 camera for Christmas. Instead of paying cash for this camera, I'm going to take a loan from my insurance policy. I'm going to pay a premium, and then I'm going to take a loan against my insurance policy. So I sent $850 to the insurance company as a premium, and then I immediately asked for a loan for $850 so I could go buy the camera. So I go and I buy the camera for Haley, and I end up paying the insurance company 5% interest on that loan. So what did that accomplish? I increased the cost of my camera by $43, right? I paid $893 instead of $850. But in the long run, over the next 50 years of my life, because I paid a premium first and started a compounding interest curve that will go uninterrupted for the rest of my life, I will earn over $10,000 on that $850 of cash. So while it might have cost me $43 in the short run in an interest payment to the insurance company, by the way, that is mutually owned by me, the policyholder, so that $43 indirectly is going to come back to me at the end of the year in the form of a dividend. Even though I paid more for my camera in the short term, I am going to earn more than 10 times the amount I spent on that camera in interest. So that's one way that I personally use my policy. Another way that I use my policy is whenever I first started my policy, my first year, I had an outstanding note on my car. And I paid my premium on my car. I had saved up enough money so that I could have gone and paid off my car and stopped my car payments and saved some of the interest that I would have paid to a bank. But instead, I paid a premium to my insurance policy. I took a loan from my insurance policy, and then I paid off my car. I paid back my insurance policy plus interest instead of someone else's bank. So what did that accomplish? Yeah, I might have paid a little more in the short run for my car because I had a 0.9% rate on my car financed over 5 years. I paid 5% interest over 1 year on my vehicle because I paid it all back in 1 year. But over the rest of my life, I'm going to earn 5% uninterrupted compounding. And guess what? I don't have to just let that sit and accumulate. I have access to that all along the way. So if that $850 that I paid into my policy 5 years from now is $1,200 with interest, I can go borrow that $1,200 and I get a second use out of that money. So now I have a camera, I have uninterrupted compounding interest, and I have access to that money, that cash that I would have paid anyway. So I'm getting multiple uses out of every dollar. In finance, you refer to this as the velocity of money, having your money constantly working. So you want your money, in the words of one of my mentor's clients, I want my money playing offense and defense. I want my money earning me interest, and I also want my money protecting me from interest that I'm paying to other people's banks. How do I get 2 uses out of every dollar? With dividend-paying whole life insurance policy, by using leverage, by taking a loan against the equity in the policy, as opposed to liquidating an asset to go make a purchase. If you want to have a conversation, just shoot me a message and we will get 15 minutes on the book. Just click on that link right there, schedule a time on my calendar if you want to talk more in depth about this, what it looks like for you. If you want to talk about policy design, how much liquidity you have year one whenever you pay a premium, how much money you have access to, we can talk about that. Yeah, so if you just have a few questions, then you can book a 15-minute call. If you want to talk more in depth about what this looks like in your life, how you might use it, what does an actual illustration design for you according to what you can pay, what you are able to pay, or what you are allowed to pay, please book a conversation with me. Thanks for tuning in. Appreciate everyone. If you have any questions, just put some time on my calendar. Thanks.